This is the second approach of capital structure, net operating income approach, which we have categorized in irrelevance approach. What do you mean by irrelevance approach? It means if we reduce the cost of capital in capital structure, it does not affect the value of the firm. It means there is no relation of value of the firm with the capital structure through cost of capital in capital structure. So what are the assumptions and who has given this net income operating income approach? This approach was given by Durand. What was his assumptions? No relationship between the cost of capital and value of the firm. Okay, this is the conclusion of this approach. Now, what are the assumptions? Because every approach starts with few assumptions, then we can go with the solving the questions. First assumption is no corporate tax. Means there is no tax on which a company can take benefit of that. Next is increase in proportion of debt in the capital structure leads to change in the risk perception of the shareholder. Lastly, when Durand give net income approach, he told that if we increase the proportion of debt in the capital structure, there is no change in the risk perception of the equity shareholder. But here in this approach, there is a change in the assumption. If we increase the proportion of debt in capital structure, there is a change in the risk perception of shareholder. It means they will expect high from the company. Next assumption is overall cost of capital and cost of debt remains constant for all degree of debt equity mix. Lastly, the cost of in the assumption of Durand, we were talking that cost of debt will be less than the cost of equity, and here we are talking about the overall cost of capital also. Means if overall cost of capital will remain constant, means debt and equity total cost will be same, and next assumption is the investor capitalize the total earning of the firm to find the total value of a firm as a whole. It means they will look at the total value of the firm. If they want to find out what is the what is the value of their earning, they will look at the total value of the company, and the equity shareholder can expect more. It means if there is a benefit of low cost of debt, but it will neutralize or it will be nullified by the equity shareholder because they will expect more return on their earnings. Now, how we can solve this question practically and how we can prove that the assumptions of the Durand in net operating income approach. Now we will go with the practical parts of this approach. Question given is EBIT. The question is related to the same question which we have solved previously, so that we can make the differences between two approach, relevance and irrelevance approach. EBIT is given 1 lakh and that is given 5 lakh at the rate of 10%. Okay, interest is 50,000. Now, here overall capitalization rate given. In last question, cost of equity was given, but here this is a difference. Here the overall capitalization rate is given. Even if both the given, you will look at the overall capitalization rate, KO 12.50%. Now you have to calculate the value of the firm and illustrate the net operating income approach. Okay. Now make a table. Existing. So first EBIT. This condition is when we increase the debt proportion by 2 lakh and here when we decrease the debt proportion in our capital structure. Okay, rest of the things will be same. Now EBIT is given as 1 lakh. This is the existing scenario. 1 lakh, 1 lakh. Now we will go with reduction of interest. Interest is 50,000, and if we increase the debt, 5 lakh plus 2 lakh, 7 lakh, 7 lakh 10%, 70,000. And here 5 lakh minus 2 lakh, 3 lakh, 3 lakh 10%, 30,000. So this comes out 50,000, 30,000 or 70,000. Okay, this is the earning available for equity shareholder. Earning available to equity shareholder. You can write down here available. Now we are discussing net operating income approach. Now total first what are the assumptions? That the investor will look at the overall capitalization rate or overall cost of the company. Okay, in this approach we are to calculate the value of the firm. First we will look at the overall capitalization rate. It means the cost of the company should be 12.50%. Okay, so how we can calculate the value of the firm under this approach? This is given to you, overall capital, total value of the firm, %12.50%. So how we can calculate the total value of the firm? 1 lakh into 100 upon 12.50. Okay, it will comes to 8 lakh. Okay, in all the parts EBIT is the same, 1 lakh, 1 lakh, 1 lakh. So total value of the firm will be same, 8 lakh, 8 lakh, now cost of debt is given to us. Cost of debt is 5 lakh. Cost of debt here is 7 lakh. Cost of debt here is 3 lakh. So cost of equity will be the balance. You can say total value of debt. Total value of debt, and it is total value of equity. Total value of equity. So balance is the total value of equity, comes to 3 lakh, 1 lakh and 5 lakh. Okay, now you have to calculate this is the total value of equity. So this is one of the part of your solution, and next you have to calculate the equity, cost of equity. Now you can calculate the cost of equity, or equity capitalization rate. Equity capitalization rate. How you can calculate the equity capitalization rate? What is the value of debt here? Total value 3 lakh. 3 lakh upon total what is the cost here? 50,000 I think. Okay, so you can write down 50,000 into 100 upon 3 lakh. This upon this into 100. So it comes to 16.67%. Here 5 lakh, yeah, 30,000 upon 7 lakh, 30,000 upon 1 lakh. This is the cost of equity. So we are calculating the cost of equity. We will write down the value of cost of equity. Into 100, it comes to 30%. And in the last 70,000 upon 3 lakh into 100, it comes to 14%. So this is the cost of equity. So how we can give interpretation? If we look at, if we increase the proportion of debt, you can check the cost of equity has been increased to 30%, and due to increase in the cost of equity, there is a, the value of the firm is 8 lakh, total value of the firm is 8 lakh, debt and equity, and due to increase in the decrease in the debt proportion, the expectation of equity shareholder has been decreased, it is 14%. But if you increase the debt proportion, the expectation of equity shareholder has increased to 30%. And what is the effect of the, due to which there will not be any effect on the change in the value of the fund, it will remain same 8 lakh 8 lakh. But what is the conclusion of this net operating income approach? If we increase the debt proportion, in capital structure, it does not goes to reduce the cost of capital, because it increase the expectation of the shareholder and they expect high return from the company. Like in this case, when we have increased the debt proportion by 2 lakh in our capital structure, it has increased the expectation of equity shareholder, and they are expecting 30% return. But if we are decreasing the debt proportion, they are expecting the less return from the 30% to 14%. So it means that the capital structure is not related to the value of the firm, and if we increase or decrease the cost of the component of capital structure, it does not affect the value of the company. Okay, because here the total value of the firm is fixed, means total value of the capital structure is fixed, that is 8 lakh. Okay, we are just if we change the proportion of that, it automatically change the expectation of, change the sentiment of equity shareholder.